Hello friends, I am Professor Nisar Ahmed Khan from Department of Economics, Aligarh Muslim University, Aligarh. I'll talk about money market. Let me write it here, money market. What do you mean by money market? What purpose it serves? What are its constituents, or submarkets, or components? These are the some questions that I'll address during the course of this lecture. So, by market we mean a place where something is bought and sold. Now, by that analogy, does it mean that money market is a market where money is purchased and sold, or money is traded? Not at all. Then what else is money market? What exactly we mean by money market? Actually, money is most liquid asset. If you rank all the assets in order of liquidity, money will come on top. This is an important characteristics and attribute of money. And this characteristic is basically because money is a legal tender within the geographical boundary of a country. Nobody can refuse it as a means of payment and for settlement of debt. Consequently, money is acceptable everywhere, and as a result, it is most liquid assets. But there are some other assets which are almost as liquid as money. These assets are basically called as near monies. We call them near monies. They are called near monies because they are very near to money. That's why they are called as near monies. What are these near monies? Near monies are short-term funds, that is the funds for a duration of less than 1 year. The maturity period of these funds is less than 1 year, maybe 1 day, maybe 14 days, maybe 3 months, maybe 6 months, like that. So, since these funds mature within a very short period of time, so the lender gets money back after a very small period of time. Consequently, these near monies are highly liquid and very close to money. So, the market in which these near monies are traded, bought and sold, that market we call is as money market. So, money market is a market where near monies are traded. Near monies are short-term funds. So, the money market we see the short-term funds, that is funds having maturity of less than 1 year, are traded. That is what we mean by money market. What purpose is served? This purpose, the money market help the business units and production units, the farmers, to get their requirement of short-term loans and to meet the requirement of circulating capital and to meet their day-to-day expenditure. So, the short term, if we see the cost, from the point of view of a production unit, either from the point of view of a farmer or from the point of view of a manufacturing unit, we see there is a variable cost and there is a fixed cost. So, money market help in meeting the requirement of funds to overcome this variable cost or to meet this variable cost. So, the money markets serve very important purpose because the circulating capital, the need for circulating capital is met from money market. Now, what are the different components or sub-markets of money market? Money market may broadly be divided into two parts. One part is known as unorganized market. Unorganized market. Unorganized market is that market where the rules of the regulatory authorities are not observed, that this market lies outside the control of regulatory authorities. Now, who are the participants in this unorganized market? The general public participate in this market as a borrower, but as far as lenders are concerned, we see there are, in this we have the money lender, they operate in this market. The landlords, they also give loans. Then there is indigenous bankers. Friends, relative, etc., they are also part of this unorganized market. Besides that, in the unorganized market, the hundi is also traded. Hundi is a Indian version of modern bill of exchange, about which we will talk in detail when we will take up the organized part of the money market, and then at that point of time I will explain the hundis. So, let us take this organized part of the market. Organized money market. Now, as the economy develops, then organized market get bigger and bigger, and unorganized market go on shrinking. That is this because there is lot of exploitation, cheating in the unorganized market, and consequently the rules are not observed, things are not transparent, and consequently as development takes place, as financial literacy increases, as financial institutions are open in every nook and corner of the country, we see that the share of organized market become very large and the unorganized market go on shrinking. So, in the organized market, we have a number of sub-markets. The one is that we have is known as bank loans, or simply we say loans from banks and non-banking financial intermediaries. Loans from banks and non-banking financial intermediaries. Non-banking financial intermediaries. Non-banking financial intermediaries like finance companies and like insurance companies, like mutual fund companies, they may also provide loan, and if they provide loan, then that is considered as part of the organized market. So, that is one segment of the money market, that is loans from the banks and non-banking financial intermediaries. This is one part. Then what are the other segments of the money market? The other segment of the money markets are, one is call money market. Call money market. Call money market is called as the barometer of money market. It is the most sensitive segment of the money market. In the call money market, the funds of one-day maturity are traded. That is, these funds are also called as overnight loans. That is, these overnight loans may be renewed for the next day, may not be renewed for the next day. So, the call money market, since the maturity period is quite short, these are very sensitive and even a small development is reflected in the call money market. So, along with this call money market, we also have a notice money. Notice money, the period is maturity period may be from 2 days to 14 days. The important difference between the call money and notice money is that in case of call money, the borrower has to pay immediately if asked by the lender. But in case of notice money market, a notice is required, and that is the important difference between notice money and call money. Or so, who are the participants in the call money market? The participants in the call money markets are usually banks, but in India before 2005, even the other non-banking financial intermediaries or the institutions who are not bank were also allowed to participate as borrower. These were Unit Trust of India and Life Insurance Corporation. They were allowed to participate in the call money market as a lender, not as a borrower. So, but from the year 2005, this market is purely interbank call money market. Interbank means that here the borrower is a bank and the lender is also a bank. So, with the only exception of primary dealers. These primary dealers are dealers in government securities. They are the only exception. Otherwise, in India from the year 2005, all other non-banking institutions have been phased out and they are not allowed to participate in the call money market either as borrower or as a lender. So, what is the rationale for the existence of call money market and how the rates are decided, rate of interest is decided in the call money market? Let us first talk about the rate. The rate of interest in the call money market is known as call rate, and it is purely determined by the market. As far as the rationale for the existence of money market is concerned, it comes from the banking business, because technically speaking, the call money market is an interbank call money market, and consequently the rationale for the existence of call money market comes from banking business. The banking business is such that banks do not know in advance as to how many people will come to withdraw money from the bank on a particular day and how many people will come to deposit money on the same day. So, the banks have to keep some cash, adequate amount of cash rather, so that no customer is turned back. But since the customers either they are a depositor or they are going to withdraw money from the bank, they do not give any advance notice. So, it is very difficult for the bank to find out as to what is the appropriate amount of cash that they should have on a particular day, so that no customer is turned back. In spite of all the efforts, it happens that on a particular day, a bank is short of cash, that there are more customers, more customers have come on that particular day to withdraw money, and consequently bank is short of cash. On the same day, there may be another bank who may be having excess cash. That is, less customer has gone to that bank to withdraw money, and consequently that bank has excess cash. So, on a particular day, there may be some bank who have excess cash and some banks may be short of cash. So, the banks who are short of cash, they can borrow cash from the banks who have excess cash. And this borrowing is just for one day, because the next day the bank will get the necessary amount or required amount of cash. So, therefore, this call money market is an institutional arrangement which facilitate the banks having are short of cash can borrow money from cash from the banks who have excess cash on a particular day. So, that's why the borrower and lender in the call money market both are banks. Now we come to the another segment of the money market, and that segment of the money market is bills market. Now this bills market is of two types. One is treasury bill. Another is commercial bill. So what are treasury bills? Treasury bills, as the name itself suggests, that this is issued by the treasury, that is by the government, and treasury bills are the instrument through which government borrow money for a short period of time. Now the question is, what is the purpose of this borrowing, and why does the government borrow money for a short period? Because the government has to carry the developmental activities which require borrowing for a longer period. Then what is the purpose of borrowing for a short period of time? Actually, government income and expenditure throughout the year, government go on getting the income through taxes and other sources throughout the year, and government keep on also spending money throughout the year. Now, while the expenditure is quite smooth because the salaries have to be paid to the employees every month, the income is not so smooth because in a certain month people may pay more taxes, in other month people may not pay so much tax, and consequently the tax payment is not smooth. It is not evenly spread throughout the year. In certain month more taxes are paid, in other month less taxes are paid. So in certain month government gets more revenue, and in the other month government doesn't get adequate revenue. Consequently, there arises a gap between the government revenue and government expenditure. This is a temporary gap. That is, this temporary gap may be for 1 month, may be for 2 months, but because in the next month when the people will deposit taxes, then government will get revenue and the expenditure can be met. So treasury bills are the instruments to bridge the temporary gap between the government income and expenditure. These treasury bills are designed for a very short period of time so that the temporary need of funds by the government can be met. So the rationale for the treasury bills is that the short-term or temporary mismatch that may arise in the government income and expenditure, that income may not match the expenditure. If income is more than expenditure, then that is good, there is no problem, but the problem arises when income falls short of expenditure. Then in that situation government may issue treasury bills, and through that treasury bills the money may be borrowed for short period and the required expenditure may be met. So consequently treasury bills are the instruments are made to meet the short-term mismatch in government income and expenditure. These treasury bills are in India of 14 days, of 91 days, 182 days and 364 days. In the year 2010, government introduced cash management bill. Cash management bill is similar to the treasury bill, and the purpose of issuing cash management bill is same as that of treasury bill. There is no difference at all. The only difference is that cash management bills are usually for a duration of less than 91 days. That's the only difference as far as cash management bills are concerned. Now, these treasury bills are very important source of funds for the government to overcome the temporary mismatch. This is not issues to meet the long-term requirement of the funds by the government, that is to carry the developmental activities for which long-term funds are needed, and that requirement is met by issuing bonds. We come to the commercial bills. Commercial bills are basically designed to facilitate the smooth conduct of trade and business. Through commercial bill, the businessman, the manufacturing unit, they may meet their requirement of short-term funds. I'll give an example and that will illustrate the importance of commercial bill and how commercial bill meets the short-term requirement of funds. Suppose there is a wholesaler and the wholesaler name is Jagatram. The wholesaler is Jagatram. And there is a retailer. The retailer name is Madan Lal. So the retailer Madan Lal has purchased goods from the wholesaler Jagatram equal to the amount of rupees 50,000. Equal to the amount of rupees 50,000. Now the problem with the retailer Madan Lal is that he is not in a position to make the payment. He says to the wholesaler that I do not have 50,000 rupees. So the wholesaler asked him, then when will you pay this money? The retailer says that I will pay this money say after 90 days. That is after 3 months. So in that case, the wholesaler says no problem, I will prepare a bill of exchange and on that bill of exchange you should sign. So the wholesaler prepare a bill of exchange. The wholesaler who prepare the bill of exchange is known as drawer of the bill. And this bill is drawn on the retailer. The retailer is Madan Lal. What is that type of bill? The bill format is given here. It is addressed to Madan Lal. His address is also mentioned here. Address of Madan Lal is given and here date is mentioned and simple one sentence is written, not more than 3 months after date, please pay to the undersigned the sum of rupees 50,000 for the value received. And then Jagatram will put his signature and also write his address here. Now this bill will be sent to Madan Lal. Madan Lal will write on this bill accepted and put the signature. This means that Madan Lal accept, yes, I have to make a payment of rupees 50,000 to you for the value received for the goods that I purchased from you after 3 months. So this bill, after signing, Madan Lal will return to the Jagatram. Now Jagatram may keep this bill for 3 months and after 3 months the Jagatram will present this bill to Madan Lal and Madan Lal will make the payment and this bill will liquidate. This is the one way. There is another way also that the Madan Lal may take this bill to his bank and the bank will write accepted on this and the bank will put the signature. A bank will write accepted and bank will put the signature and also stamp. Now once the bank put the signature and stamp, then this document, this bill of exchange becomes a marketable document and this can be traded in the market. Now after this bank has written accepted and put the signature and stamp, the Madan Lal will return this bill to Jagatram. Now Jagatram again has two options. One is that he can keep the bill for 3 months, wait for the maturity and once it it has matured, then he may deposit in the bank and get this money. Or in the bank has written accepted, the bank does not provide this service free of cost, bank charge acceptance fee for that. And it means that in case Madan Lal fails to make the payment, the bank will make the payment. So bank is giving a type of guarantee. So consequently, after 3 months, Jagat Ram may deposit this bill in the bank and get his money back. That is one option available to Jagat Ram. In case Jagat Ram needs money immediately, say after 1 month, Jagat Ram needs money, then he can sell this bill in the market. This bill will be sold at a discount. Discount means at a price which is less than the face value of the bill or the amount mentioned on the bill. The amount mentioned on the bill is 50,000, so it will be sold at a less price. So this is what we call as discounting of bills. Now this discounting service may be provided by a bank. A commercial bank may discount it. So therefore, if the bill is again discounted, then it is called as rediscounting. Though since bank has put the stamp and signature, this document carry the value and become a marketable instrument and can be sold as well as purchased, that is, can be discounted. The bills are always discounted. When bills are sold in the market, it means bills are discounted, that is, bills are sold at a price less than the face value of the bill. Now this bill is helping the Madan Lal to meet the short-term requirement of the fund, that he was looking for rupees 50,000 loan so that he can purchase goods from the Jagat Ram, and after selling these goods, that is after 3 months, he was interested to make the payment. That facility is being provided by this bill of exchange, which is drawn by the Jagat Ram, and it is drawn on Madan Lal. So Jagat Ram is a drawer and Madan Lal is a dry. So this is a commercial bill. The commercial bill market, is very important segments of the money market, in the sense that it meets the short-term requirement of traders. And these commercial bills are also important because these commercial bills are self-liquidating. Then we move ahead and we take another segment of the money market, and that is known as term money market. Term money market is a market in which the money is borrowed for a period of, in India, usually it is from 15 days to 1 year, but now in India it is for a period of 7 days to 1 year. 7 days to 1 year. Earlier it was 15 days because then the banks were not allowed to pay interest on deposit of less than 15 days. But now that period has been reduced from 15 days to 7 days, and consequently the term money market, the borrowing, the funds that are borrowed can be of a maturity of 7 days to 1 year. Now, who are the participants in this term money market? Term money market is an unsecured market. That is, no collateral is to be produced by the borrower. Same is the case with the call money market. The call money market, no collateral is needed. Usually you know that when a person borrows money, he has to produce a collateral. Collateral is an asset produced by the borrower to protect the interest of the lender. So that asset is not required. That is, both call money market as well as term money market are collateral free, unsecured market. So term money market, the word term because the money is for a particular term. Now in this term money market, the borrower and lender are banks. But recently in India, some other all India financial institutions are also allowed to operate in this market as a borrower. this term money market, the rate is determined by the market. And as far as India is concerned, the banks borrowing from the bank in the term money market are exempted from the requirement of cash reserve ratio and statutory liquidity ratio. So, this term money market is very important in the sense that the call money market and the bill market, they are for a shorter duration, and this term money market, relatively the money can be borrowed for a relatively longer period. Yes, of course, the period is less than 1 year. So, we come to the another segment of the money market, and that is repo market. Repo is a repurchase agreement. Repo is simply an instrument where the seller sells the securities to the buyer with the promise to repurchase it after a given duration and at a given rate of interest. Now, here the buying and selling takes place simultaneously in the sense that there are two legs. One leg is not simultaneously, rather there is a gap between the two. So, we say, for example, here we say seller, and here we have buyer. The seller may be, you can take commercial bank. Commercial bank is a seller and the buyer is a central bank. In India, you can take RBI. So, the commercial banks sell the securities to RBI with the promise to repurchase these securities after a given period of time. So, in the first leg we see that commercial will give the securities to central bank, and the cash will be given by the central bank to the commercial bank. Then there will be second leg, and in the second leg the securities will be purchased by the commercial bank from the central bank. That is, these securities that commercial bank has sold will be repurchased by the commercial bank, and then the commercial bank will make the payment, that is cash will be given plus interest will be given by the commercial bank to the central bank. So, there are two legs. In the first leg, the seller will sell the securities and get the cash. In the second leg, the seller will repurchase the securities that he has sold earlier and give the cash. So, the difference of the period between these two legs is known as repo period, and the difference in the amount that the seller has got when seller sold the securities and the amount that seller is paying when the seller is repurchasing the securities, the difference in the two amounts is the interest. And if we express in terms of rate, then this is the interest rate, and this rate is called as repo rate. And the market in which this transaction takes place is called as repo market. So, repo market is such a market in which the buying and selling takes place. You know that securities, there is no outright sale or purchase of the securities. Usually when securities are sold, then we forget. If you want to buy again, then you will purchase again. But here what actually happens, that securities are sold with the promise to repurchase the same after a period of time. Now, the gap of the difference between the period is known as repo rate. Now, this repo is a very important tool in the hand of the central bank to modulate liquidity in the money market and regulate the rate of interest in the money market. Now, if when the central commercial bank sell the securities, central bank will give the cash. So, the cash is flowing from the central bank to the commercial bank. So, therefore, this central bank is injecting cash in the market. But when this cash is being paid by the commercial bank to the central bank, cash is going to the central bank again. So, through repo, the central bank can inject liquidity in the market. There is a reverse repo also, which is just opposite of the repo. That is, here the commercial bank is selling, but in the reverse repo, commercial bank will be buying the securities. So, while repo is used for injecting liquidity, reverse repo is used for absorbing liquidity. So, with this repo and reverse repo, the central bank may modulate liquidity in the money market and can regulate the rate of interest. These repos are of several types. There may be fixed repos, there may be term repos. That is, the fixed rate of interest repos are just maybe for overnight repos. We call them as overnight repos. The overnight repos may carry fixed rate of interest. The rate of interest on the repo may also be variable, and we may also have a term repo, that is repos for a specific period of time, say for 14 days. So, there the repos may be term repo or repos may be overnight. Then the repos, the securities which are traded here are usually the government securities. So, we see that there may be repo for the government securities and there may be repo market for corporate securities. So, that is different repo, the repo for government securities and repo for corporate security. In the case of government securities, only in the case of government securities repo, the securities used are only government. But in corporate securities, in the repo market for corporate securities, the securities are used are corporate securities. So, this repo, after this repo, we turn to another segment of the money market, and that is known as commercial papers. Commercial paper is a promissory note, and that is issued by the companies looking for short-term funds. These companies are the companies, highly rated companies, that is, all companies may not be allowed to issue commercial papers. Only the highly rated companies, the reputed companies, are allowed to issue commercial papers. So, the issuer of the commercial papers in India are the companies, highly rated companies, primary dealers, and all India financial institutions. They usually issue the commercial papers, and these commercial papers are for a duration of 7 days to 1 year. These are for a duration of 7 days, say 7 days rather, not 7, 7 days to 1 year. So, commercial papers are simply, who are the buyer of these commercial papers? The commercial papers are purchased by the commercial banks, by the NRIs, by the foreign institutional investors, and by the non-banking financial intermediaries. They may also purchase these commercial papers. So, commercial paper is a tool for the companies to borrow money for a short period of time, that is, for a period from 7 days to 1 month. We have now another segment of the money market, and that is known as certificate of deposit. Certificate of deposit known as CDs, the commercial papers are known usually as CPs, and certificate of deposits are known as CDs. Certificate of deposits are issued by the banks. Those banks who are in need of short-term funds, that is, they are short of funds and they can issue certificate of deposits. The certificate of deposits is also for a period of 7 days to 1 year and it is in given denomination. The certificate of deposits may be purchased by the companies, by the NRIs, by the foreign institutional investors, and also by non-banking financial intermediaries. So, while commercial paper is a tool to meet the short-term requirement fund of the companies, the certificate of deposit is a tool for the banks to meet their short-term requirement of funds. Now, both commercial paper as well as certificate of deposits are sold through auction. That is, the rate of interest on the commercial paper and certificate of deposits are decided by the market. Both commercial paper and certificate of deposits are sold on discount. So, these are the two instruments, satisfying the requirement of banks and companies of short-term funds. Then we have another segment of the money market known as money market mutual fund. Money market mutual fund. Money market mutual fund is similar to the mutual fund operating in capital market, which are known as mutual fund, not the capital market mutual fund. We call them as mutual fund, but when we call them mutual fund, then we mean the mutual fund operating in the capital market. So, there is no difference in the mutual fund operating in the capital market and money market. The only difference is that in the case of money market mutual funds, the funds obtained from the investor by the mutual fund company is invested in different segments of the money market. So, that is the only difference. In the case of the mutual funds operating in the capital market, the funds obtained by the mutual fund companies from the investor is invested in different segments of the capital market. But here the mutual fund companies will invest the funds in the different segments of money market. So, money market mutual fund provide an opportunity to common man, to layman, to benefit from the money market, because if you look at the different segments of the money market, the common man is not allowed to participate either as a borrower or as a lender. Only in some segment the common man can participate, and that too as a lender, not as a borrower. For example, the common man may purchase treasury bills. The common man may also purchase commercial bill. That is possible. But then the other segments, the common man is not allowed to participate either as a borrower or as a lender. So, this money market mutual fund ensure the participation of common man in different segments or components of the money market. Now, this is all as far as money market is concerned. Thank you very much. कितना टाइम हो गया साहब? ज़्यादा हो गया क्या?